This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. It is a Jobs Tuesday. No, you're not screwed around with your calendar.
Zone.
What?
The Twilight Zone.
It is the Twilight Zone. Very good afternoon across Bloomberg platforms. This is Bloomberg Businessweek Daily. Carol Massar, Tim Stenovec. Yeah, we've got those stocks. They're down, but they're coming off their worst levels of the session. I look at the S&P 500. More names are lower today. We've got the Treasury trade kind of bouncing around a little bit, but we're going to get into some of the data that we got today. Sluggish U.S. jobs growth, resilient consumer spending. We got our own McKee and also the Labor Department's chief economist, Julia Pollak. She's going to be here.
Yeah, also the macro and micro, from private credit to cryptocurrencies to banking, and Fannie and Freddie. A deep dive with Whalen. He's going to be joining us in just a few minutes.
And Bitcoin fatigue, you know all about it. We've seen Bitcoin
down
retrench.
30% from all-time highs.
Yeah, on track for a down year, the fourth down year it would be in its history. We're going to talk with Fred Thiel, CEO of Massar, see what he has to say about that. We've got a lot of questions coming his way.
All that over the next hour right here on Bloomberg Businessweek Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie.
All right, thank you very much. And happy Jobs Tuesday, a phrase we never say here at Bloomberg. We have got stocks very much in the red, but as Carol set us up, well off session lows right now. 31-point drop on the S&P, 67.84. Drop right now of roughly 0.4%. Dow Industrials down 320, a drop there of 0.7. The Nasdaq Composite Index down 22 on Nasdaq. That is a drop now of 0.1%. Interestingly, the Mag 7 Index holding on to a gain of 0.2%. The Russell 2000 Index of small cap shares down 0.6%. The American jobs market, though, sluggish but not rapidly deteriorating. Non-farm payrolls increased 64,000 in November. The unemployment rate at 4.6%. Our Michael McKee is going to have a whole lot more coming up on Bloomberg Businessweek. 10-year, 4.15%, with the 2-year right now, 3.48%. Gold, little changed, up 0.1%, 43.10 the ounce. But in the oil market, seeing quite the move for West Texas Intermediate. 55 handle today, 55.41. WTI down 2.5%. Bitcoin up 1.8%, 87,732 on Bitcoin. Pfizer is forecasting little to no sales growth next year as the drug maker undertakes an effort to refresh its pipeline of hit drugs with a series of pricey acquisitions. Pfizer shares, they're down today by 5.2%. So again, recapping here, the Dow, the S&P, Nasdaq, all in the red right now. S&P down by 0.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. All right, we did get a bunch of economic news today. We did have the U.S. government dropping Labor Day for the past 2 months. U.S. job growth remains sluggish in November. The unemployment rate, Tim, though, rose to a 4-year high, so pointing to a continued cooling in the labor market after a weak October.
Well, with what you need to know, Bloomberg TV and radio, international economics and policy correspondent Michael McKee, he joins us here in the Bloomberg Businessweek studio. The jobs data, did it tell us what we already knew?
Basically, low higher economy seems to be the story here. We had a really bad October. Now, we only got the establishment figures, the ones that include how many jobs were created. For October, we didn't get anything on the household side, the unemployment rate, but we did get both for November. What it looks like in terms of job creation is October was terrible, in part because 162,000 government employees who had been fired by DOGE fell off the payrolls. They were getting severance and they fell off the payrolls. But there were also job losses in just about every category in October. And then we got a bit of a rebound in November. Most of those jobs, health and welfare workers, the people who've been propping up the job market for quite a while, but it was something. But it tells you that we're not seeing much hiring. at least at the end of November, we weren't seeing much hiring. But we're not seeing a lot of people getting fired either. Hard to tell from the unemployment numbers because we didn't get October, but we did see a tick up to almost 4.6%, rounded up to 4.6%.
All right, so that's the case when it comes to the labor market. U.S. retail sales showing a resilient consumer spending beyond cars. So how do we cross that?
Well, they take the cars out, and you look at the cars, building materials, gasoline. Gasoline always goes up and down because of prices.
Right.
And what you had was a reasonably strong core rate, what they call the core rate of retail sales. So it's basically the stuff that does go into GDP directly. And that was a significant turnaround from what we had seen in September. Again, this is October data, but we're just getting it now.
Right.
So it isn't clear how important that's going to be because a lot of it was at department stores, which may have been the tail end of back to school, or it may have been really early Black Friday or whatever you want to call it, Christmas stuff. And so we're going to have to get a couple more months of that. The same with the jobs data before the Fed will have any kind of idea of where we really are. Brings us sort of up to date, but not statistically valid, as they like to say.
Sort of, but not quite yet. Is basically. All right. Mike, thank you so much. Bloomberg TV and Radio International Economics and Policy correspondent Michael McKee. We're going to stay on the macro with a financial sector emphasis. And great to have back with us Chris Whalen, chairman of Whalen Global Advisors. He worked at the New York Fed in the 80s. He's testified before Congress and the SEC, worked on Wall Street. I forgot that you worked at Bear Stearns and
Twice.
Some other written many books, and also served on the Economic Advisory Committee of FINRA for over a decade. And you also were a consultant to Billions, was that right?
Yes, it was great fun. They were buying a bank.
They were buying a bank, and they wanted to know?
Yeah, they were trying to, finagle the regulators. It was a typical Billions kind of script.
Well, out of the entire resume that Carol just mentioned, was that the most fun, working on Billions?
No, I think the most fun was early days working at Bear Stearns in London, selling bonds. That was a lot of fun. We had a blast.
Well, tell us about, it's funny, I love talking with someone like you because you have seen just kind of how the financial sector has changed a lot, Chris, right? And the stress points that we've seen, certainly the financial crisis and elsewhere. When you look at, we just talked with Mike about some of the macro backdrop, and we've talked with you about specific risks, but does it feel comfortable today, kind of the environment, in your view, compared to what we've seen in the past?
No, I was going through the third quarter numbers for the big bank holding companies, which the Fed just released.
Yeah.
Day 75 after the quarter close. That's the best that they can do. And it's eerie. The credit costs are trending down. Asset returns, thank God, are getting back to normal, about 1.5%. But there's a lot we don't see. And that's what's worrying people. Whether you talk about Oracle or you talk about private credit, what people are worried about today is what they don't see in the data, because they know that a lot of this is being fudged. And that's what worries me as well.
What do you think is being fudged?
Things like loan losses. There's a lot of forbearance here in New York City for multifamily apartments. Our new mayor is threatening to start taking over buildings that landlords are not keeping up to his standards. Well, the city of New York can't afford to take care of them either. And so we have this accumulation of pressures, mostly caused by inflation, mostly caused by our friends at the Fed. But in their defense, why did they do that? Because we told everybody they didn't have to pay their loans and their rent for 2 years during COVID. People forget that in the mortgage industry in March of 2020, we were all looking at one another going, what are we going to do? This is after President Trump declared the emergency and said, you don't have to pay your bills.
Yeah.
Well, the Fed came to the rescue. By dropping rates to zero, we caused a surge of home lending activity, record volumes, and that float was borrowed to help everybody pay their bills.
So why aren't we seeing more stress in the credit markets? And why are we seeing records on Wall Street? And it sounds like then some disconnect.
I think part of the reason that the street has been doing well, listed stocks, is because you have a lot of liquidity coming out of private markets, going back into more liquid markets. Makes sense, right? Private equity, private credit is a mess. And we all know this. Something like 15% of private equity companies in the U.S. are paying in kind rather than in cash.
Right.
So you notice
we keep waiting for the year to the exits and for things to move on.
There's a lack of demand from banks for loans except in one category, non-depository financial companies, which is another way of saying private equity funds, credit shops like Ares and Apollo. They're the ones that have been aggressively expanding their business, using money in part from banks. So the banks are now the facilitators. And what does this remind us of, Carol? The 2000s.
Right.
It's the same thing. You have non-bank intermediation relying on the bond market, equity markets, and bank credit. And the thing is, eventually they're going to stumble. And that's what everybody's worried about, I think.
So what does that stumble look like?
Yeah.
What is the shoe that drops?
It looks like First Brands. Hello, we're defaulting. And most people had never focused on that company. It was a private, totally institutional play. The same thing with Tricolor. Auto lender that, half of their customers were illegal aliens. Nobody had ever focused on this. It was an institutional story that suddenly surged
So you
into
think
the
those
consciousness.
you think those two instances are canaries in the coal mine?
I think they are typical of what we're going to see more in the future, which is you're going to see more of the missteps in the institutional non-public market, which was supposedly better. Remember, everybody was selling us the idea that private was better than public? No, we have public markets because they're open and relatively liquid.
Chris, after the Jamie Dimon cockroach comment, that there were many members in the private world that came out, or a few, I should say, that came on our air, and that seemed to say, hey, listen, things are fine. And I understand many would say they're talking their book, but, are they systemic risks? Like, what's the exposure with the traditional financial sector when it comes to the private markets? Because I think that's what we care most about, right?
No, I think the private players can fail tomorrow. It will cause a bit of kerfluffle and volatility in the markets. But are they systemic like a big bank? No. But the big banks will take their lumps too, because they are lending indirectly into these structures. They tend to take the most senior positions, but that may not save them. You see, the assumption that, okay, I'm senior and 3/4 of the stack is below me, and therefore I'm okay, that may not work this time around because you have leverage on leverage on leverage in some of these deals.
So when like the big banks report again, we're getting ready for another earnings cycle, right? We'll get that, in early January. So what do we look for things like that? Like, what do you look for?
The numbers are going to be wonderful. That's what worries me. Just as an analyst, we were supposed to have a recession last year. Credit losses largely peaked last year, third, fourth quarter.
Yeah.
They've been coming down since then. So if you look at the picture, you say, God, everything is great. You don't see a lot of utilization. You don't see a lot of demand from the banks for credit. They've got a ton of unused credit out there that they wish people would use. But so you don't see stress in the published numbers. Where you see stress is when you talk to professionals, when you read the really interesting media like Bloomberg and others that cover some of these stories. There was a great piece in the FT over the last week talking about Altus, a company that Jamie Dimon came to the rescue of, paid off their most restrictive loans so that they could go out and borrow more money.
So
and all the credit guys that you're talking about looked at Jamie Dimon and they're going, hello, what are you doing?
Yeah.
So he's an enabler of bad behavior because Jamie has to go out and make money too in a market where there isn't a lot of, what I would call quality demand.
Which reminds me of what would happen in the great financial crisis, of people saying, I know it's getting messy and ugly, but there was the CEO of Citi at the time, I think, who came out and made some comment about, I got to be in it.
Oh, no, that's right. Yeah, that was the
I can't think of
the temporary CEO who replaced John Reed.
But I'm just saying, this idea of feeling like you have to be in it, the pressure of it.
Yes and no. I think that some institutions have the common sense to pull back and say no.
Yeah.
Others don't. I'll give you an example. PNC. PNC has the lowest loss rate in the top 7 banks. They've also got one of the lowest funding costs. That's a fairly well-run $500 billion bank that has managed to avoid risk, I think often by saying no. The street wanted them to get more involved in certain things like prime brokerage, dealing with private equity funds, that sort of thing.
Right.
And they said no. So I think there are institutions that are very well run in this market. But again, the banks are underutilized because the non-bank financial companies have stolen their march. And they're going to the customer and they're using wholesale funding from the big banks. And they're in turn disintermediating them at the same time.
Chris, we want to talk a little bit about AI too in the time that we have left. We've talked about it with you before. Circular financing, we're not sure how it all plays out in the economy and what it has to do with productivity and with economic growth. Weighing in on AI and its potential economic impact, Ken Griffin of Citadel, speaking with Bloomberg's Danny Berger a little earlier today at a conference in Paris. Check out what he said.
I think there is some chance that we will see meaningful progress in this field that will change the calculus that I'm setting forth. Like, there are so many bright people in their 20s and 30s trying to unlock true intelligence, that this does create the environment in which a breakthrough may happen. But I think that generative AI, as we know it today, will have a very pointed but relatively limited impact on the broader economy.
A pointed but relatively limited impact on the broader economy. Ken Griffin of Citadel earlier today. What, in your view, is the impact of AI on this economy?
I think it's incremental, better search tools. You know, we're writers.
So is he right?
I think he is right. And frankly, I read a lot of the long-haired stuff on AI, some of the people in the scientific community, and they tell you the same thing, because this is a third or fourth, fifth time that we have talked about AI. You go back to the 70s and the 80s.
It's not new.
Remember Watson, IBM, which was a fiasco. But it was their way of showing what new technology could do. But is it creating general intelligence? No.
So is all this a waste? Is all this a waste?
No, it's marketing. You know, never.
Yeah, but that's a lot
to
to spend on marketing.
But the spend, yeah.
But that's, look, everything in the U.S. economy is about marketing, okay? Doesn't matter what it is. And if it's attached to a stock, then you know it's marketing. NVIDIA. I've made a ton of money on NVIDIA. I'm very grateful to Mr. Wang. But is he going to change the world? No. What we're doing is building a lot of infrastructure. We're spending a ton of money, not so much on building AI, but preparing to have the capacity to do it, mostly by studying the past. To me, that's not AI. AI is when a machine can start to observe what's around it and react and determine what to do next based on what it sees. Not because of, you know, it's studied our language for the last 50 years.
So you understand, like, the whole idea of AI is all the data that's put in from the past. You think that, okay, that's your take.
It's all we have.
Well, are you still in NVIDIA?
No, I got out. I wrote it up, it split. I wrote it up again, it split. When it gets to be a third of my portfolio, I've got to take the money and run. You know, with all due respect to Jim Cramer, who I'm very grateful to for getting me into that stock.
But it sounds like you're saying that we're in a bubble, with at least with the spend.
Of course we are. That's what humans do. That's what markets are about.
So what happens when this bubble...
We follow the shiny object.
What happens when the bubble pops?
We're going to see that a lot of the spend for AI will not be compensated with revenue growth that's going to help to pay it off. And Oracle, I think, unfortunately, a great company, is the poster child for this. They were following the crowd. They decided to double down and do even more. And the truth of the matter is, one large language model, if all of the tech companies had gotten together and said, look, let's do this together.
Right.
Right? But the other problem, I think, is the metaphors that we use in this conversation, this race with China. The Chinese don't use metaphors like that. When you listen to them talk about AI, it's part of a broader range of initiatives that they're trying to use to give them an advantage in the global economy. They don't see it as a race. This is all marketing hype. And we have to differentiate between the technology and the sell, okay?
Yeah.
It's like we used to say about IBM, never mistake sales with, you know, delivery. No.
All right, we got to leave it there. Thank you. Really appreciate it.
My pleasure.
Chris Whalen, chairman of Whalen Global Advisors, joining us here in studio. Coming up next, we didn't get to talk crypto with him.
No, that's okay. We're gonna have Chris back very soon. We are talking crypto next, though. Not its year, at least Bitcoin's year, on track for its 4th annual decline in its history. And this year's a little different because there was no sort of catalyst for that decline. The CEO of the crypto miner Mara stops by next. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ, all lower. S&P, in fact, trading very close to session lows. Jobs Tuesday. S&P down for a third day today. Right now, lower by 46 at 67.70. That is a drop of just about 0.7%. S&P lower as a noisy jobs report leaves bonds wavering. The 10-year currently yielding 4.15% with the 2-year 3.47%. Gold higher, little changed, up 0.1%. Spot gold up $4 the ounce, 43.09 where we stand now. Silver down 0.7%, heading in the other direction at 63.73. West Texas Intermediate crude oil 55.33 a barrel. So, right now, WTI down 2.6%. Brent, the global benchmark, just below $59 a barrel, down 2.6%. And Bitcoin currently higher by 1.4%, 87,409. So oil extending its declines today. Brent dropping below 60 for the first time since May as indications grow that supply is outpacing demand against the backdrop of efforts to end the war in Ukraine. Among some of the oil majors, ExxonMobil down 2.5%. BP, the ADR is particularly hard hit, down 4.1%. Chevron right now is down by 1.9%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, along with Tim Stenovec, live here at Bloomberg headquarters in New York City. Hey, we talked about this at the top. Bitcoin not having a great year. It's headed for its fourth annual decline in its history, and the first one that didn't coincide with a major scandal or industry meltdown. So we're talking about cryptocurrencies, the Bitcoin specifically, now nearly 7% lower for the year. It's down around 30% from its October 6th all-time high. Volumes low and investors, Tim, bailing on Bitcoin ETFs. You know about this. You do a weekly Bitcoin show. You know.
Yeah, I mean, the bear market means that Bitcoin has decoupled from stocks. The S&P 500 closing in at a record earlier this month, up 16% for the year. Bitcoin struggled to find footing. The Bitcoin miner and accumulator, Mara Holdings, knows all too well about the drop. Its own stock down more than 36% so far this year. Nearly 28% of the float is shorted. With more, we head to Paris and to Fred Thiel. He's chairman and CEO of Mara. Fred, good to have you on the program. The decline in the asset price this year, certainly, $126,000. That was a major high earlier this year. That was a big moment for the cryptocurrency, but down close to 30 or more than 30% from that. How much lower does Bitcoin go?
I think Bitcoin at this level is finding support in the kind of 84,000 range, which is just about where the break-even point is on most ETF purchases, Bitcoin ETF purchases, and that seems to be a level of support where essentially people, large investors who are trying to defend their positions, if you would, want to keep it above that level, which if it falls below that, you'd see more sales most probably out of the ETFs back into liquidity. Bitcoin, it's very much driven by global liquidity. You had expectations of more from the Fed and more clarity around market structure. But I think what you really have to look at is there was a huge run up in the kind of August through September into October period. And, a number of us felt the market was frothy in the beginning of Q3 and things were getting a little bit overheated. And, now we've seen some of that come off. You've also seen a lot of money that rotated into AI, now rotating out of AI and starting to rotate into more Dow stocks. And so I think you're generally seeing a risk-off environment. Risk-off tends to drive people out of Bitcoin. But the liquidity that the federal government is going to inject in the marketplace, now that quantitative tightening is over, we're starting to see easing again. We believe that will bode well. The dollar's down, which also bodes well for Bitcoin. And I think you're going to continue to see Bitcoin appreciate. But you've got to realize it's a very large asset class. It's a couple $1 trillion in size, and it takes a lot to move the price. And I think what we're seeing now is just some healthy retracement.
Hey, if I may, just jump in for a moment. I am wondering, Fred, you say that it's a risk-off environment, and yet I'm looking at an S&P 500 that's still near its all-time high. And we've seen quite a bounce back when it comes to the S&P 500, also a very big market. So I'm just curious, how do you square that if we're seeing investors still willing to move into the equity markets but not crypto? That disconnect.
Well, I think you have to, in regards to crypto, you have to look at the derivatives market, which is much bigger than the actual spot Bitcoin market. And you have to see the sheer amount of leverage and positions that have come off since the peak. You've gone from the $90 billion-ish range down to the $30 billion range of open positions. And so that's a huge amount of leverage that comes off, which essentially sucks wind out of the marketplace. And people have been moving their money out of Bitcoin and into other things. I think you've also seen, look at the AI stocks. Most of the second-tier AI stocks have all seen a pretty large come down since the peak. Even stocks such as Oracle, look at CoreWeave, look at these stocks and how they've performed. And I think what you're seeing is a rotation out of some of those and into other stocks. And Bitcoin is associated with technology. It's associated with a risk on assets, and it's very associated with liquidity.
So having said that, and you talked about the run-up that we saw earlier in terms of crypto, that where it got to maybe like frothy levels, we're now at what, 87,000 and 87,302 and change. So what do you think should be the level of crypto that makes more sense?
Well, I think you have to look at the long-term trend, but more importantly, go back a little over a year ago, go 14, 15 months ago, no U.S. Money center bank would deal with crypto-related companies, nor would they take crypto deposits, nor would they let you trade crypto, nor would they let you wire money to crypto exchanges almost. And today, you have every bank, including JP Morgan, now moving ahead and doing all sorts of things with crypto. You're seeing tokenization of assets. DTCC has now gotten a no action letter from the SEC around tokenizing assets. You're seeing all sorts of activities around the traditional finance environment where they're embracing crypto. And I believe that what part of the effect of that is you're now going to see all sorts of things wrapped around crypto, which will make the space much more relevant. But it takes time for those products to take effect, get launched. And I think, again, Bitcoin has had a great run. Over the past 15 years, it's been one of the best performing assets on record. And I think that we're going to continue to see great performance out of Bitcoin over the coming years.
So, Fred, you're a Bitcoin miner. You're also a Bitcoin accumulator. We've spoken to Eric Trump of American Bitcoin. And I'm curious, he's also a miner, also an accumulator. What makes your company different than American Bitcoin?
Well, any company that mines Bitcoin is performing the exact same service for the Bitcoin network, which is essentially assembling transactions into blocks and then competing to win the right to essentially add that block to the blockchain. What differentiates Mara from American Bitcoin, we own all our, we own about 70% of our hosting operations. We're fully vertically integrated. We own power generation. We generate energy off of wind farms, off of flare gas and oil fields. We operate on 4 continents. We also are fully vertically integrated from a technology perspective. We operate our own pool. We co-founded the only U.S. ASIC manufacturer for Bitcoin mining ASICs. The rest of the market is all dominated by Chinese companies. And we have been very proactive in helping drive a lot of the growth of crypto around partnerships with energy companies. And I think, we're still considerably larger than American Bitcoin, not just in our mining operations, but also in the amount of Bitcoin that we hold on our balance sheet.
On the identity part of this, trying to understand what the company looks like, you guys issued a statement this week saying you're not a digital asset treasury firm. You should not be excluded from MSCI, whereas the company said it has been adopting a Bitcoin treasury strategy by holding its mined coins. What is the difference between being a treasury company versus a company that adopts the treasury strategy? Help us with the nuance there.
Sure. So a Bitcoin treasury company, for example, like Strategy or MicroStrategy, as it's formerly known as, has acquired all of its Bitcoin by purchasing it. Mara has mined the majority of its Bitcoin. We've also purchased Bitcoin in the market, but most of our Bitcoin is the product of our mining operations. We have chosen to hold our liquid assets in Bitcoin because we believe, again, better to hold our cash in the best performing asset class over the past 15 years than to hold it in fiat, which is continually losing its value, or just to hold it in treasuries, which will only, pay a dividend of, low single-digit percentage points. So Bitcoin has been an excellent place for us to hold our cash, and will continue to be so, we believe, over the long run. But we generate Bitcoin by mining Bitcoin. We're not out in the market buying Bitcoin on a regular basis like MicroStrategy. We have from time to time gone into the market and bought it when we think it's very opportune. Last year, there was an opportunity to buy Bitcoin when it was in the $60,000-ish dollar range. And we bought Bitcoin because we had a feeling, it was a belief rather, that it was going to go up, which it did. And there are times where we're opportunistic like that. But we sell Bitcoin that we produce to fund our operating expenses. So, we are not a company that holds our Bitcoin, every single Bitcoin that we have. We actually sell Bitcoin from production to fund our business. So we're an operating business. Bitcoin mining is our primary business. And Bitcoin just happens to be how we hold our funds.
Fred, one thing I'm just curious, though, going back to what we've seen in terms of the fatigue in the price and Bitcoin coming down, what's interesting is, and I'm just looking at some of our reporting and commentary, you've got a White House that's very much favoring the digital currency world. You have the president declaring crypto a national priority. U.S. Congress has passed a landmark stablecoin legislation, and Bitcoin exchange traded funds were raking in billions of dollars. We've seen acquisitions. We've seen so much movement. And again, I'm going back to the decline that we've seen in crypto. It's a pretty favorable environment. So, is all of the good expectations in terms of news already priced in and it can't get much better?
I think like anything, any asset will revert to mean, and Bitcoin has simply reverted to mean. It has most probably overcorrected. But you had in the past 6 months a huge amount of accumulation by the plethora of digital asset treasury companies that were formed. You go back not too long ago, it was basically MicroStrategy was the only real one. You had MetaPlanet to a lesser extent. Semler Scientific was a smaller one. And we were a large holder of Bitcoin. That was kind of it. And then all of a sudden you had all sorts of companies come out of the woodwork. What did they do? They raised cash. They went and bought a bunch of Bitcoin, which drives the price up.
Right.
Price comes up. People start putting money into ETFs. You start getting bigger derivative positions.
Okay.
And it's a flywheel effect. And if you just draw a trend line over the past number of years, you'll see Bitcoin has just reverted to mean.
Got to run. Fred, thank you so much. Fred Thiel, Chairman and CEO of Mara. Just want to mention real quickly, Wall Street Journal reporting that the president said to interview Fed's Christopher Waller for chair.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks in the red. S&P 500 index lower for a third straight session. Right now looking at a loss of 34 points at 67.82 on the S&P. A decline right now of 0.5%. Your Dow Industrials, they're down as well right now, lower by 376 points. The Dow at 48,041, down 0.8%. NASDAQ Composite Index down 33. On NASDAQ, a decline of 0.1%. On a down day for much of the market, we are looking at gains right now for the Bloomberg Mag 7 Index, up by 0.2%. The 10-year on this Jobs Tuesday, 4.15%, with the 2-year currently yielding 3.48%. Gold, little changed, up $2 the ounce, 43.07. That's an advance of just about 0.1%. West Texas Intermediate crude down 2.6%, 55.33 a barrel, and Bitcoin now up 1.4%. Bitcoin 87,433 on Bitcoin. Visa is opening its U.S. network to stablecoin settlement, expanding crypto-linked products and services enabled by a relaxed regulatory environment under the second Trump administration. Visa shares down today, down 0.7%. Rival MasterCard also trading lower. A MasterCard right now down 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, so appreciate it. We'll be back to Charlie for another update a little bit later on. Hey, we talked about the market, the U.S. jobs market earlier with Michael McKee. It's sluggish, not rapidly deteriorating, and we did see that data that came out, saw traders refraining from boosting bets on near-term Fed rate cuts, setting stocks lower and bonds wavering. So we're not, it's not like all of a sudden traders are saying, okay, we're going to get more rate cuts because of that labor data we got this morning.
Yeah, a reduction is fully priced in by mid next year,
Yeah.
we should know, but we're not seeing those bets go up.
No, exactly. Curious to see what our next guest has to say specifically about the U.S. labor market. Let's head to the Bloomberg News Bureau in D.C. to someone well known to our Bloomberg audience. She was formerly chief economist over at ZipRecruiter. She is Julia Pollak, and she's chief economist for the U.S. Department of Labor. Julia, good to have you back here on Bloomberg. How worried are you about rising unemployment?
I'm not. So this report understates the strength of the labor market right now because there are two huge temporary distortions at play in the data here. The first is 100,000 or more federal workers who took the fork and came off payrolls, and some of them have gone into temporary frictional unemployment. And the second big distortion in this report is the Schumer shutdown, which forced 900,000 federal workers off the job, but it also led to weakness in the private sector because it forced work stoppages for federal contractors and led to temporary layoffs there. So I expect the unemployment rate to jump back down very soon.
What about the youth unemployment rate, the rising youth unemployment? Are you concerned about that?
So, the unemployment rate is exactly where it was when President Trump first took office in his first term, and he has a track record of bringing it all the way down to 3.5%. We have a bigger challenge this time because of the Biden inflation hangover, which forced the Fed to slam the brakes on the economy, and that has hurt marginal workers the most. But we are setting the stage for a huge comeback in 2026 and beyond with the One Big Beautiful Bill Act, which has hugely stimulative policies. And you'll see those macro stimulative effects build into 2026. They are things like expensing, fast and accelerated, full and accelerated expensing for business investments, no tax on tips, no tax on overtime, no tax on Social Security.
So, Julia, if I may just jump in, just because we only have about 5 minutes left here. So it sounds to you like that there's, and we've heard this certainly from guests here on Bloomberg, more liquidity coming into the market, things to support economic growth. It sounds like you said that the labor picture is actually better than what the data showed. So it sounds to me then that the Fed is correct, Jay Powell is correct in being, actually, forgive me, what you're sounding like you're saying is that maybe the Fed doesn't need then ultimately to be cutting rates, that things actually look pretty rosy for 2026.
So I think the reason that employment growth, the job growth slowed so dramatically between mid-2022 and mid-2024 is that rates were high, and the longer rates stay restrictive, the more of the economy gets hurt. The more businesses have to refinance at double the rate, the more families go out there and try to buy a home and find that it's just unaffordable. So rates right now are still restrictive, and they are still a problem for much of the economy.
But you said you weren't concerned about rising unemployment, so I'm a little confused.
Well, the Fed has a dual mandate: full employment on the one hand and price stability. And this president has shown that his policies deliver both. In the first Trump administration, we had non-inflationary growth, and you can do that with policies that don't, throw fuel on the fire of demand and restrict supply, but do the exact opposite. So through deregulation, through reshoring incentives, we're going to see this labor market take off again, and in a non-inflationary way.
Well, on the reshoring part of this, a motivation for reshoring, onshoring, imposing tariffs to bring back the Midwest, to revitalize what many consider the American dream. Secretary Bessent has said it's been harmed by global trade. The manufacturing industry, though, it keeps shedding workers. When can we expect the data to reflect progress that the administration is trying to make in restoring that American dream?
So the economy shed manufacturing jobs for about 2 years before President Trump took office again. This latest report shows the largest increase in construction jobs in over a year. And that's really the front end of those investments in mining, in energy, and manufacturing. And they're a signal that manufacturing job growth will pick up.
So, okay, you know, you look at the labor market, I mean, in terms of initiatives that will potentially help the U.S. labor market, you know, the conversation around artificial intelligence. Fed Chair Jay Powell even addressed it in saying it hasn't impacted U.S. jobs yet. So I'm just curious, how are you factoring that into as you look at some of the upcoming moves? The president ramping up in terms of hiring people to really focus on technology, AI specifically in the administration. So looking to make more investments so that the U.S. certainly has a dominant role. I'm just curious how then you factor that into your estimates for the impact on the U.S. labor market.
Well, the AI boom is driving huge demand for workers in the skilled trades, in advanced manufacturing, and of course, workers with AI skills. And it is our job at the Labor Department to ensure that U.S. workers are prepared for those jobs of the future. For the first time, labor policy and education policy are pulling in the same direction. We've aligned labor and education for the first time ever. And we are now focusing very heavily on getting workers access to job-connected training that sets them up for in-demand jobs and that doesn't push them to expensive degrees that leave them with nowhere to go.
Let's talk personnel a little bit. We're curious about why it's taking so long to make another nomination as BLS commissioner. Is your name in the ring? Is your hat in the ring?
I have no idea. You'd have to ask the president that.
Would you, if you were asked, would you serve as that?
Well, I think there is a tremendous amount of work to do there, tracking AI's labor impact, improving the timeliness, the granularity, the accuracy of the data. And I have, at the Labor Department, made it my priority to push forward a very aggressive labor market data modernization agenda that puts workers and learners first and gives them more access to the data collected on them. So right now, I love partnering with the BLS on all of those kinds of initiatives, and I am happy to serve in whatever role the president sees fit.
If we're thinking just 30 seconds, but if we're thinking about previous commissioners, how will this nominee or this next commissioner be different? Just 20 seconds.
I have no idea, but I think that whoever comes in has a very clear mandate from the president to put workers and learners at the center of what we do, to change the data paradigm to a real-time data paradigm, and to make sure that the data is accurate and has the utmost integrity.
All right, Julia, thank you so much. Julia Pollak, Chief Economist for the U.S. Department of Labor. Right now we've got stocks bouncing off their lows of this session. When we come back, we take a look at stocks on the move. Back in a moment.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we're coming up on the last hour of trading on this Tuesday, this Jobs Tuesday. Don't get used to it, Stenovec.
Okay.
I mean, who knows? You know, just when you think you figured everything out, things do change. Speaking of changes, we're bouncing around in the equity markets, just down about 25 points on the S&P. We're off our worst levels of the session. You've got a Dow that's down 330 points, and you've got a NASDAQ 100, call it flat, but it's up about 12 points. But again, all of those major averages off their worst levels, and we're seeing some momentum moving to the upside.
Yeah, this on a day when energy is taking a hit as oil prices fall to the lowest in years. Energy down 2.9%, healthcare down 1.6%, real estate down 0.8%, consumer discretionary and information technology barely in the green, but they're in the green.
All right, I'm Carol Massar along with Tim Stenovec. Let's get to some of the stocks on the move on this Tuesday. Bloomberg News equities reporter and deputy team leader for U.S. equities, Carmen Reinicke, is in the house. Where shall we begin?
Yeah, let's start with Pfizer. This is ticker PFE. So it's down about 4.5% right now. The drug maker forecasts little to no sales growth next year. So it's sort of a warning sign for the drug maker. It's looking to rebuild its pipeline of hit drugs. I think the stock is still down, 50% since COVID, in trying to sort of rebuild that. And it also comes sort of after a series of pricey acquisitions that the company has made. So basically they said revenue in 2026 will be between $5.5 billion to $26.5 billion, and that really fell below the midpoint of what analysts were expecting in that time period.
Yeah, the stock down about 5% so far this year. I mean, this is just such a far cry, Carol, from what this company was a few years ago when this was one of just a handful of companies that had developed what people saw at the time as a COVID vaccine.
At a time when we were like, did you get the Pfizer or the Moderna?
Yeah.
I mean, that's basically what we did. I mean, it was on a tear. You go back to 2021, it was up 60%, 60%. But, hence life after COVID, right? These guys have to think about their pipeline and what's next.
Down 47% from 2021 highs.
Yeah, right? Like we know this story. All right. Where do we go next?
Let's look at Xcel Energy. This is ticker XEL. It's down nearly 3% right now. So Texas Attorney General Ken Paxton is suing the company, accusing it of blatant negligence over its role in the Smokehouse Creek wildfire. It caused more than $1 billion in damage last year and killed 3 people. He actually had said in August that he was investigating the company here and claims that they prioritize sort of environmental and diversity goals over maintenance. Xcel did acknowledge that its infrastructure likely caused or was involved in starting the smokehouse fire, but it has refuted sort of all of the accusations of negligence.
Yeah, I remember this as being a mover when those fires were going on, Carol, and I would come back to it day in, day out that, hey, this shares of Xcel down again. As a result of her concern about the wildfire.
Yeah, I mean, this is kind of the new reality, right?
Also on a day when we're seeing energy companies take a hit.
No, and that's
oil prices falling too.
Right, layer that on top of it. Hey, I want to go to Comcast. This is like a top gainer in both the S&P and the NASDAQ 100. I had to move around, look around, because I was looking at this one earlier today.
Exactly. So it's the top performer on the S&P right now. It was a little bit hard to find. I wanted to find at least one stock that was up today. So this is ticker CMCSA. It's up about 4.6% right now. So what we've reported at least is that CNBC's David Faber speculated on possible activist involvement in the company, basically commenting on some interesting trading activity that he was seeing, particularly in the swaps market and sort of in options trading around Comcast. So looking at that, it is the best day since July 31st. So a pretty good jump.
Yeah, I thought it was kind of interesting too, poking around. What?
I love that David Faber is the one doing this. I mean, he's like, okay, Comcast still owns CNBC. They're going to spin off into Versant.
Correct.
Which and Comcast will still have a large stake of Versant, but it's like, what are you looking around the building for something going on, right?
Yeah, exactly. And I think the media space is just of interest right now, right? Totally. So, but it's I feel like there's We have to kind of wait and see what happens with this name, right? But I thought the same thing. I was like, why is this one moving so much? Stock is down about 21% year to date, so we have seen it certainly under pressure. All right, Carmen, thank you so much. Carmen Reinicke with Stocks on the Move, our Stock Movers podcast. Catch it. You can find it. 5-minute episodes of the biggest winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts. All right, folks, we're coming up on the last hour of trading on a day when we got a little bit of economic news. You've got equities kind of moving around, but little changes overall, except for the Dow, which is down about 0.7%. But for those who are watching on TV, the close is coming your way, but we got lots more coming up in the next hour of Bloomberg Businessweek Daily.
Yeah, I'm looking at shares of Ford down about 0.2% right now. They were higher earlier in the session. We're going to speak with Keith Naughton in just a minute, and we're also going to play you some of that Jim Farley tape from yesterday. What is the next era of EVs as Ford retreats from an EV strategy that it vowed to go all in on just 8 years ago?
I got this headline on this story by our own Craig Trudell about the electric car transition unravels slowly, then all at once. It does feel like reality here in the U.S. that things have changed a lot. At the same time, I don't know. I look about on the roads. I see more EVs than I have seen in a long time. And go beyond
hybrids though.
Go beyond
That's
the U.S.
the bridge. It's the bridge
Yeah.
to the EVs.
Or go beyond the U.S. borders,
Yeah.
right? China and elsewhere, like you see a lot of EVs. All right, do not go anywhere. The close coming your way on TV. Tim and I continuing right here on Bloomberg Businessweek Daily.